Welcome back to the Finance Homefront, where we bring you the latest updates that matter most to your wallet. I'm Bev, and today's video is packed with breaking news straight from the Federal Reserve. The suspense is over. They've just announced a crucial decision on interest rates that could reshape the entire economic landscape. In a surprising move, the Fed has hit the pause button, keeping interest rates steady at 5.5%. What does this mean for you? Well, it might just be a groundbreaking moment. We could be witnessing the peak of this economic cycle. If you're someone who's eyeing the real estate market, considering a new car, or even managing credit card debt, this news is absolutely something you should pay attention to. But the story doesn't end here. I'll be diving deep into the potential ripple effects and what this decision could mean for your finances. If you're excited as I am about dissecting these developments, do me a favor, hit that like button to show your support. And for the freshest updates right when they drop, make sure you're subscribed and that notification bell is ringing loud and clear. Now, let's get started. So if that's the scenario, if we truly hit the pause, if we initiated that phase, then you already anticipated what follows: interest rate cuts. The Federal Reserve will inevitably cut interest rates. It's just a matter of time. Regardless of when they decide to make the cut, it's crucial to understand that an easier monetary policy is on the horizon. And this holds significant implications, especially for those aiming to purchase a home, considering mortgage interest rates, or looking to buy a car with auto loan interest rates. If you're dealing with credit card debts, or if you're an investor concerned about asset inflation and the broader economy, these changes will have an impact. Following the Federal Reserve meeting, they have opted to maintain the Fed funds interest rate at 5.5%. If you've been staying informed, this decision shouldn't catch you off guard. It aligns with our expectations. Now, let me explain what happens next. The upcoming Federal Reserve meeting is scheduled for January 31st. However, it's unlikely that the Federal Reserve will cut interest rates during that meeting, and the market seems to agree. Currently, the market estimates a mere 5% chance of an interest rate cut at this particular meeting. The subsequent meeting is set for March 20th, and it's during this gathering that the market significantly raises its expectations for a Fed pivot. While I'm not overly optimistic about the Fed making a pivot at this meeting, the market perceives a higher likelihood, assigning it around a 40% chance of an interest rate cut according to the CME FedWatch tool. Personally, I find these odds to be quite inflated. It's worth noting that the Federal Reserve is indicating a commitment to maintaining the higher interest rates for an extended period. But the market doesn't seem to give much credence to the statements from Jay Powell or the Federal Reserve. The plot thickens as we move towards the May meeting, where market expectations become remarkably optimistic, with roughly a 75% chance that the Federal Reserve will cut interest rates. The period leading up to and during the May meeting holds the promise of intriguing developments. Looking ahead, the market strongly suggests a hefty 90% chance of the Federal Reserve cutting interest rates by the June meeting. This anticipation arises from the possibility of the Federal Reserve making moves as early as March, impacting rates on mortgages, auto loans, credit cards, and business loans. However, two critical factors come into play. Firstly, the recent CPI inflation report is a bit alarming, with core inflation staying at 4%, double the Fed's target. If inflation, especially core inflation, remains high, cutting interest rates may not be their first choice. Secondly, there is concern about wage inflation, which currently stands at 5.5%. Although higher wages seem positive, the Fed aims for 2%, seeing high wage inflation is problematic for overall inflation. It's a tricky situation. Here's the thing. The Federal Reserve aims to keep wage inflation at 2%, not the current 5.5%, as high wage inflation contributes to overall inflation. Despite a robust jobs report with 199,000 additions in November and a drop in unemployment to 3.7%, sustaining wage inflation above 2% makes the Fed less likely to cut interest rates. So expectations for a March rate cut might be too optimistic. Yet, there are other factors that could prompt the Fed to cut rates sooner, and I'll delve into 3 of them. Keep in mind, there could be additional factors in play. 1. There's a significant problem in the world of commercial real estate. A massive $540 billion of U.S. commercial real estate debt is due in 2024, and there's even more coming in 2025. To avoid a crisis, this sector needs a lifeline in the form of lower interest rates. And sooner than later, it's a race against time. 2. Let's talk about banks. They might seem okay, but their balance sheets tell a different story. Holding on to loans with low interest rates, if these rates go up, the value of these loans drops. Luckily for them, they don't have to show these losses unless they try to sell the loans. Lower interest rates would be a relief for them. 3. The U.S. government. Despite a good credit rating, they have a habit of borrowing more money to pay off old debts. If interest rates go up, it becomes pricier for the government to borrow. In about 4 years, they'll be spending more on interest than on defense. So it's in the best interest for interest rates to go down, and the sooner, the better. It's like a financial puzzle, and lower interest rates would be the missing piece. You need to know that the Federal Reserve, the group that can lower interest rates, is not part of the government. It's a private organization. There are arguments about this, but what's clear is that the Fed will likely make a move in 2024. Whether it's in March or July, a Fed pivot means an easier monetary policy, stimulating the economy and causing prices to go up, leading to faster inflation. Now, this impacts everyone, but if you're thinking about buying a home, pay attention. When the Fed lowers interest rates, mortgage rates will drop, which sounds good. However, it also means more people will want to buy homes, driving prices higher. That's not great news for potential home buyers. So, how much will mortgage rates drop? The market thinks the Fed will cut rates by a total of 1.5% next year, bringing the rates down from 5.5% to 4%. This means mortgage rates will still be around 5%, affecting not only home buyers, but also many Americans looking to refinance high-interest mortgages. It's a big deal for a lot of people. Let's focus on 2024 for a moment because that's when the interest rate cuts are expected to start. It's likely they'll continue into 2025. Now, when it comes to home prices, it all depends on how fast and how big these interest rate cuts are. The key factor is demand, and lower interest rates tend to make more people want to buy homes. Now, think back when we had 8% mortgage interest rates. Even with rates that high, home prices didn't really change much. They stayed pretty steady. So just picture what might happen if interest rates drop to 5%, 4%, or even lower. That could mean a lot more people wanting to buy homes, and that might drive home prices up. It's something to keep in mind. Thanks for tuning in. I hope you found this breakdown insightful. Now I'm eager to hear your thoughts. What do you think about the Federal Reserve's potential interest rate cuts and the factors at play? Drop your comments below. I love engaging with your perspectives. If you enjoyed this video and want more content like this, give it a thumbs up, subscribe to Finance Homefront, and don't forget to ring that notification bell. Remember, this is not financial advice. Make sure to do your own research or consult a professional before making any financial decisions. Stay informed and be part of our growing community. Until next time, take care and happy investing.